Interest rates go up again, and I'm going to tell you why. So, welcome to our weekly rate review here. Last week, interest rates went up again from 6.96 to 7.09. And already since last Thursday, when these numbers came out, interest rates have gone up significantly more. So, this is the average Freddie Mac survey of lenders showing that the average rate that's going right now is 7.09. Now, there's some discount points, and it depends on the lender there. So in order for you to find out exactly where rates are for you, you need to talk to your lender. And so I've got one borrower that's closer to 8%. Now, last week on Friday, we saw that CNBC was talking about interest rates hitting 8%. And, I was flabbergasted, but when I went to look at rates today, he's got a little bit lower FICO scores, but that interest rate is close to 8% with zero discount points. So are we going to head to 8%? I think we will. Let me just give you a couple of ideas of why I think maybe we'll see interest rates keep on going up. The U.S., there's a lot of talk that the U.S. economy is not in a recession. And yet I feel like it's a 50-50 chance that we will be in a recession. And I tend to lean towards more of a 60 or 70% chance we're going to be in a recession, just because we've got interest rates that the Federal Reserve has raised so high. And I call them the unintended consequences. We're seeing interest rates affecting, some of our shipping companies, trucking companies. We saw Yellow Line go out of business. We're starting to see that could be a huge problem with office buildings and commercial real estate not being full, because a lot of people, like me, are not working at the office every single day. We're going to start seeing, I think, unemployment numbers start to go up here as well. And also, there's a higher credit card usage today than ever before. It's over $1 trillion of credit card debt. And so what's happening is that borrowers have been used to having the excess money that came in through the pandemic, the stimulus money, and they're, instead of cutting back on their spending, they're just using their open lines of credit and kind of living that way, thinking, okay, if I can just get through the next 6 months, maybe we'll start seeing things come down and I'll be able to pay off my credit cards down the line. The other thing too that's happening is that before the pandemic, there was a $500 billion savings that people had in their savings. It was 500 billion is what they were estimating. And then before the pandemic, it was like $100 billion. And so in June, it looks like for the first 3 or 6 months of this year, the savings depletion went down 190 billion. That means people are taking money out of their savings so they can still continue to buy, and that is helping our economy to stay solid. But eventually, that's going to start to falter. Now, I want to just share with you my screen so you can see what the actual rates are happening here. So let me just flip over here and show you where the 10-year Treasury is going. As you can see, it's been going up and up and up. And when we went above this floor of support, but then we've kind of come back here. If I go back a little bit further, so let's just go back a year, you're going to see that floor of support is right here. And then after that, it's going to be this. So there's quite a bit of area that interest rates could rise if they don't, kind of taper off right now. And a lot of that's going to be dependent upon what happens this week with the, what do I want to say? The Federal Reserve and that are meeting in Jackson Hole, Wyoming. And this is the Fed chairmen of many, many companies are coming, and they're going to discuss interest rates, not only here and what Jerome Powell sees, but also what interest rates are happening all over the world. So that's, I think, one of the things that are going to, and that's on Wednesday. The other thing that you're going to look at here is on Tuesday, we've got existing sales that could move interest rates even higher than this. We can see that Thursday is the unemployment numbers that are going to come out too. as well, and retail sales. So those can all drive the market. Let's just go over to the bond market for just a quick second so you can see. And this is what's happening is that interest rates, have gone down or have been going up for a long, long time. When the bonds go down, that means that it's harder to sell those rates. And that's exactly what's happening. Like you can get a pretty good rate, maybe 7% with a 1% discount point. But to get to 0 discount points, it's the margins are tightening there. Let's go back a year so you kind of just see how this kind of all plays out here. Oops, that's 3 years, sorry. And so you can see that back in October 26th of 2022, we were in the same area that we're at right now, a little bit lower. Right now, we haven't, hit that. And as you can see, during the quarter, let's go to the quarter here. We're still in pretty good shape to bounce off of this because we went below and then we came back up. So hopefully we're going to see some good economic news that is going to help us with getting into maybe a little bit lower rates. But for now, my suggestion is if you're going to buy a house, lock in your rate right now. You can always renegotiate a rate come down if rates come down between now and closing. And then, if you find the perfect house, you're going to want to buy that now. And then with the idea that within 12 to 24 months, you're going to refinance that. And there's some things that we can do to help you minimize that payment shock, like a 2-1 buy down, which I'll go over tomorrow on my Facebook page here. And to see all these videos, if you want to go back ways, go to my YouTube channel. It's Mark Johnson _ guaranteed rate. All right. Thanks for listening, and we'll talk to you soon.